Welcome to Sphere Finance. I am Price Time and you're watching Sphere TV. It has certainly been a painful year for crypto and for the global markets. Financial pain can often drive counterproductive decisions based on fear or greed. We all must constantly face and come to terms with these and other emotional states, especially as we turn our focus towards financial decision making. Avoiding emotional decision making requires thinking ahead, being aware of and understanding our emotional states and the financial risks at stake, and maintaining disciplined action. When these are practiced, it becomes possible to turn the table and take advantage of the emotionally charged actions of others. As Warren Buffett famously said, "Be fearful when others are greedy, be greedy when others are fearful." This illustrates the importance of managing emotions and taking disciplined financial actions in order to have the markets serve you, instead of you serving the markets. Still, this is far easier said than done. Two approaches that can help investors make financial decisions that are not driven by emotions are dollar cost averaging and diversification. Dollar cost averaging is a simple way that an investor can reinforce the practice of building wealth over the long term while simultaneously ignoring the short-term volatility of the markets. It involves regularly investing the same dollar amount into the same investment consistently over time. Dollar cost averaging, or DCA, can be useful for beginners and for long-term investors alike, though it may not be for everyone. Let's go through some of the pros and cons of DCA as an investment strategy. When it comes to price changes of an asset over time, with DCA, the net result is that you as the investor will receive the average share price based on the movements of the market. If an asset was decreasing linearly over time and you decided to DCA the same dollar amount every week, then your average share price would be in the middle, resulting in a smaller net decline in your portfolio compared to if you had invested everything from the beginning. However, this also works the other way. If an asset was increasing linearly over time and you decided to DCA the same dollar amount every week, your average share price would again be in the middle, resulting in a smaller net increase in your portfolio compared to if you had invested everything from the beginning. Realistically, this type of linearity rarely happens within the market, if ever. Also, it can be extremely difficult to appropriately time the market, especially when emotions are running high. DCA allows investors to mitigate the risks of poor market timing while simultaneously removing the emotional component from their decision making. With DCA, investors continue on a preset course regardless of how wildly market prices are moving. They simply set the plan and then stay the course. This helps the investor capture the average price movement of the asset over time, regardless of volatility. However, DCA is not a substitute for identifying good investments, and it does not solve all investment risks, such as the risks of a declining market. DCA also assumes that although prices may fall temporarily at times, they will ultimately rise. Therefore, investors must still do their own research before opting into a DCA strategy, or any investment strategy for that matter. Investors should also consider monitoring their investments and strategies, including DCA, as new information may call for an investor to rethink their approach. Overall, dollar cost averaging is a powerful tool for beginner investors and long-term investors alike. It helps reduce the impact of market timing and emotions in the decision-making process, two pitfalls that can otherwise cause investors to serve the market. By sticking to well-thought-out strategies such as DCA, investors can turn the table to have the market serve them. How often you DCA and with how much may depend on your investment horizon, the general market sentiment, and your experience with investing. Another easily implemented approach to help make disciplined and cognizant financial decisions is through diversification. I've covered diversification in previous videos, but in a nutshell, diversification is the holding of a wide variety of assets in order to reduce your overall portfolio risk while simultaneously maximizing your overall portfolio's return to that of the market average, which turns out to be a better overall return compared to what most can achieve on their own. Sphere Finance is setting the foundation to be the S&P 500 and meta-governance kingpin of crypto, whereby with one token, the Sphere token, users will gain exposure to a growing variety of cryptocurrency assets and will wield increasingly concentrated voting power from an increasing number of valuable projects. Stay tuned for more information. The best place to stay up to date on announcements or contact us is through the Sphere Finance Discord. Check the description below for official links. You can also leave us a comment below and we will do our best to help. After all, this video and channel is for educational purposes only and is not financial advice. Thanks for watching, and always remember that you matter for who you are.